You walk into a restaurant. The host gives you two options. Option 1, the all-you-can-eat buffet, $25 flat. You get a little bit of everything. Steak, sushi, pasta, tacos, dessert. Some dishes are amazing. Some are mid, but you'll never go hungry. Option 2, order a single dish off the menu. Maybe it's the best meal of your life. Maybe you get food poisoning and spend the next 48 hours regretting everything. That's the difference between ETFs and individual stocks. An ETF, an exchange-traded fund, is a basket of stocks bundled together into a single investment. Like the buffet giving you a plate with salmon, tuna, shrimp, a California roll, and edamame. You don't pick individual items, you get the whole spread. The most famous ETF is SPY. When you buy one share, you're buying a tiny piece of all 500 companies in the S&P 500. Apple, Microsoft, Amazon, JP Morgan, all of them, one purchase. In 2024, there were over 3,400 ETFs holding $10.4 trillion in assets. The buffet is booming because people figured out it's a really good deal. Now, let's talk about ordering off the menu. You see NVIDIA at 120 in January 2024. You go all in. By year end, you feel like a genius. But what if you picked Peloton at 160 in 2021? By 2024, it was under $5. That's financial food poisoning. Here's the brutal stat. Just 4% of all publicly traded stocks accounted for the entire net wealth creation in the US stock market from 1926 to 2019. The other 96% collectively matched treasury bills. Ordering off the menu can get you the best meal of your life, but the odds are stacked against you. Every buffet has a price. In ETFs, it's called the expense ratio, the annual fee for managing the buffet. Here's the beautiful thing. Index ETF buffets are absurdly cheap. Vanguard's VOO charges 0.03%, $3 a year on $10,000 invested. Compare that to actively managed funds, the Chef Special, averaging 0.66%. Over 30 years, that fee difference costs you over $100,000. And the expensive Chef, 95% of actively managed funds underperformed the S&P 500 over 20 years. Warren Buffett bet $1 million to a hedge fund manager that a simple index fund would win. Buffett won easily. Here's the biggest advantage of the buffet. If one dish is bad, it doesn't ruin your meal. You ate 30 different things. One questionable shrimp won't take you down. This is diversification. When Silicon Valley Bank collapsed in 2023, if you owned SVB stock, you lost everything. If you owned SPY, SVB was 0.04% of the fund. You didn't even notice. In 2022, Meta dropped 64%, Netflix fell 51%, but the S&P 500 as a whole dropped 19.4% and recovered entirely by 2023. The buffet keeps restocking. Old dishes get swapped for new winners. The optimal strategy? Go to the buffet every week. Same day, same amount. This is dollar cost averaging. $500 every month into VOO. When the market is high, you buy fewer shares. When it crashes, you buy more. If you invested $500 a month starting January 2000, the worst possible timing, by December 2024, your $150,000 invested would be worth approximately $580,000. The buffet also has themed stations. That's sector ETFs. Technology, XLK. Healthcare, XLV. Semiconductors, SMH. You get diversification within a specific cuisine. Should you ever order off the menu? Absolutely, but only after you filled up at the buffet first. The framework: put 80 to 90% in low-cost index ETFs. That's your foundation. Then take 10 to 20% as play money for individual stocks you've researched. Never put more than 5% in a single stock. And be honest, keep a spreadsheet. Track every pick against SPY. Most people discover their brilliant picks underperformed the boring buffet. That's not failure, that's data. The buffet gives you diversification, low fees, and historically market-beating performance versus 95% of professionals. It's boring, it's reliable, it works. Individual stocks can deliver life-changing returns, but the odds are against you. The smart move? Fill your plate at the buffet first, then grab a dish or two off the menu with money you can afford to lose. This is Make Stock Money. We'll see you in the next one.